What if the global economy you live in today, the interest rates you pay, the prices you see, the policies governments follow, was shaped by one man's ideas? What if the financial system guiding trillions of dollars across the world still runs on a blueprint created decades ago? And what if the rules shaping modern markets were not inevitable, but chosen? In the 1970s, the world's most powerful governments faced something deeply unsettling. They realized they were losing control. Inflation surged, unemployment climbed, economic growth slowed. The economic playbook trusted for decades, the one that promised stability and predictability, suddenly stopped working. Policymakers had believed they could manage the economy like a machine. Increase spending, unemployment falls. Reduce demand, inflation declines. The system seemed measurable, adjustable, controllable. Then reality intervened. The model failed, and with it collapsed the belief that governments could permanently fine-tune complex economies. But while many were shocked, one economist was not. For years, he had warned that policymakers were misunderstanding the system. He argued that inflation was not merely a side effect of growth, but a signal of deeper imbalance. He insisted that unemployment could not be engineered permanently lower through policy manipulation. He believed attempts to control the economy too precisely would eventually create instability. His name was Milton Friedman, and whether people agree with him or not, the modern global economy still operates within the intellectual framework he helped construct. To understand why Friedman mattered, you must first understand the world he challenged. After the Great Depression, confidence in free markets collapsed. Banks failed, businesses closed, and unemployment in the United States exceeded 20%. Economic output contracted dramatically. The belief that markets would quickly correct themselves seemed naive, even dangerous. Into this crisis stepped economist John Maynard Keynes. He argued that markets could remain trapped in prolonged downturns if demand collapsed. In such moments, government spending was not harmful, it was necessary. Deficits during recessions could restore employment. Public investment could stabilize economies. Governments, Keynes believed, should actively manage economic cycles rather than simply observe. After World War II, this philosophy became the dominant framework across Western economies. Governments expanded spending during downturns. Central banks supported growth. Regulation increased. Economic policy became an exercise in management rather than restraint. And for a time, the system appeared successful. The 1950s and 1960s delivered strong growth across the United States and Western Europe. Industrial production expanded. Wages increased. The middle class grew rapidly. Inflation remained moderate. Unemployment remained relatively low. Many believed they had discovered a formula for stable prosperity. At the center of this confidence stood a powerful idea known as the Phillips curve. Economists observed a statistical relationship suggesting that inflation and unemployment moved in opposite directions. If unemployment fell, inflation tended to rise. If unemployment rose, inflation fell. The implication was seductive. Governments could choose their preferred balance, slightly higher inflation in exchange for permanently lower unemployment. The economy seemed manageable, like a dashboard with adjustable settings, and the belief in control became irresistible. But Friedman saw a fundamental flaw. He argued that the relationship between inflation and unemployment was temporary, not permanent. Workers and businesses, he explained, would eventually adjust their expectations. If governments increased inflation to reduce unemployment, people would anticipate rising prices. Wages would increase. Businesses would raise prices. The temporary employment gains would disappear. You could not fool an economy forever. Friedman introduced the concept of a natural rate of unemployment, a level determined by structural factors such as technology, demographics, and labor markets. Attempts to push unemployment below this natural level through monetary expansion would only create accelerating inflation. It was a quiet but revolutionary idea, and it was part of a broader argument that would define his legacy. Inflation, Friedman argued, is fundamentally a monetary phenomenon. When the supply of money grows faster than the economy's ability to produce goods and services, prices rise. Too much money chasing too few goods. Today, this idea seems obvious. At the time, it challenged the dominant economic thinking. During the 1960s, policymakers focused heavily on demand management. Governments adjusted spending to stabilize the economy. Central banks often responded to political pressure. Monetary policy lacked consistent rules. Money supply growth fluctuated. Friedman believed this discretion created instability. Governments, he argued, tended to react too late, then overcorrect. They stimulated when convenient and restricted when inflation became visible. Economic volatility was not a failure of markets, it was a failure of policy. His solution was discipline. Central banks should follow predictable rules governing money supply growth. Policy should be constrained rather than improvised. Stability required limits. Markets, in his view, were powerful coordination systems. Millions of individual decisions, guided by prices, allocate resources more efficiently than central planning. Government intervention, unless carefully limited, distorted these signals and created unintended consequences. This was not a moral argument, it was an argument about incentives. Bureaucracies respond to political pressures. Markets respond to price signals. The difference, Friedman believed, shaped outcomes. For years, his ideas remained controversial but marginal. The post-war economic system appeared stable. Growth was strong. Inflation was manageable. The consensus remained firmly Keynesian. Then the 1970s arrived. The global economy was hit by severe oil shocks. Energy prices surged. Production costs rose. Inflation accelerated while economic growth slowed. Unemployment increased. The world experienced stagflation, high inflation and high unemployment simultaneously. The existing economic framework had predicted this could not happen, yet it did. Friedman's explanation suddenly appeared convincing. Years of expansionary policies had increased inflation expectations. Workers demanded higher wages. Businesses raised prices. The attempt to maintain low unemployment produced persistent inflation instead. The model had failed. In 1979, U.S. Federal Reserve Chairman Paul Volcker adopted policies aligned with Friedman's thinking. The central bank dramatically tightened monetary conditions. Interest rates surged. The result was painful: recession, unemployment, and widespread economic disruption. But inflation fell sharply. By the mid-1980s, price stability returned. For many policymakers, this confirmed the importance of monetary discipline. Central banks worldwide began prioritizing inflation control. Independent monetary authorities became common. Policy shifted toward predictable rules rather than discretionary intervention. Friedman's ideas reshaped global economic governance. The transformation extended beyond central banking. During the 1980s, governments embraced deregulation, privatization, and market competition. Economic policy increasingly emphasized private enterprise and reduced state control. Markets were no longer viewed as fragile systems requiring constant supervision. They were seen as efficient mechanisms for allocating resources. Financial markets expanded rapidly. Global trade accelerated. Capital moved freely across borders. The world entered an era increasingly defined by market-driven economics. Growth followed. Innovation accelerated. Productivity improved. But another transformation occurred simultaneously. Wealth accumulation became closely tied to ownership of financial assets. Stock markets expanded dramatically. Housing values increased. Capital markets deepened. Economic gains were not distributed evenly. Markets optimized efficiency. They did not guarantee equality. By 2026, the world still operates within this framework. Central banks focus intensely on controlling inflation. Recent price surges following pandemic-era stimulus led to aggressive interest rate increases between 2022 and 2025, demonstrating continued commitment to monetary discipline. These actions reflect the continued influence of rule-based monetary policy, where credibility and price stability remain the foundation of economic confidence. Global financial markets have reached historic scale. Wealth generated through financial assets has grown rapidly. At the same time, debates about inequality, corporate concentration, and economic power have intensified. Governments and policymakers increasingly face pressure to balance economic growth with concerns about fairness and long-term financial stability.